July 2nd, 1997. Bangkok, Thailand. In less than 24 hours, a single decision will wipe out $40 billion. Entire region's wealth will vanish. And the world will watch as currencies that stood for decades collapse like dominoes. This is the story of how Asia's economic miracle became its worst nightmare. Throughout the early 1990s, Asia was unstoppable. Thailand, Indonesia, Malaysia, South Korea, these weren't just developing nations anymore. They were the future. Western investors called them the Asian tigers. Growth rates hit 8, 9, even 10% per year. Money poured in from everywhere. American banks, European funds, Japanese corporations. Everyone wanted a piece of the Asian dream. Thailand led the charge. Bangkok transformed into a gleaming metropolis. Glass towers rose from rice fields. The Thai baht was pegged to the US dollar at a stable rate, 25 baht to $1. Rock solid, reliable, safe, or so everyone believed. The Thai government made a promise. The baht would never fall. The central bank would defend the currency no matter what. Foreign investors loved this guarantee. They borrowed dollars cheaply and invested in Thailand, confident the exchange rate would never change. But promises and reality don't always match. By 1996, cracks appeared. Thai banks had lent billions for real estate projects. Shopping malls sat empty. Office buildings had no tenants. Construction sites became ghost towns. The export boom that built Thailand's wealth was slowing down. Still, the money kept flowing in. Foreign debt climbed higher. $70 billion, $80 billion, $90 billion. Most of it was short-term loans. It's money that could be pulled out at any moment. The Thai central bank governor was a man named Rinchai Marakanand. Smart, experienced, confidence. He believed Thailand could weather any storm. He had $40 billion in foreign currency reserves, enough to defend the baht against speculators. It was wrong. Currency traders began to notice the problems. George Soros, hedge funds in New York and London. They saw the empty buildings, the mounting debts, the slowing exports. They smelled blood. In early 1997, they started borrowing Thai baht, selling it, buying dollars, then waiting. If the baht fell, they'd buy it back cheaper and pocket the difference. Classic speculation. The Bank of Thailand fought back. They bought baht, sold dollars from their reserves, kept the exchange rate stable. Day after day, week after week. But defending a currency is like holding back water with your hands. May 1997, the pressure intensified. Speculators attacked harder. The Bank of Thailand burned through reserves faster. 30 billion left. 20 billion. 15. Rinchai made an announcement. The baht will not be devalued. Thailand's economic fundamentals are strong. Financial markets didn't believe him. By late June, Thailand was bleeding money. Reserves dropped to dangerously low levels. The government tried everything. Capital controls, interest rate hikes, emergency measures. Nothing worked. Behind closed doors, officials faced a terrible choice. Keep fighting and risk total bankruptcy, or surrender. Float the currency. Let it find its own level. Admit defeat. On July 2nd, 1997, Thailand blinked. The government announced the baht would float freely against the dollar. No more peg. No more guarantees. The market would decide its value. Within hours, the boat crashed. 25 to the dollar became 28, then 30, then 35. Thai companies that borrowed in dollars suddenly owed 40% more in baht terms. Banks that seemed solid yesterday were insolvent today. Businesses that survived decades collapsed in days. Thailand was just the beginning. Indonesia watched nervously. Malaysia too. The Philippines. South Korea. They all had similar problems. High foreign debt, weak banks, overvalued currencies pegged to the dollar. Currency traders noticed. If Thailand could fall, so could they. By mid-July, the Indonesian rupiah came under attack. Then the Malaysian ringgit, the Philippine peso. Each central bank promised to defend their currency. Each central bank spent billions trying. The Malaysian Prime Minister Mahathir Mohamad was furious. He called George Soros a moron. He blamed Western speculators for destroying Asian economies. These are currency traders who have no concern about the consequences of their actions, he declared publicly. But anger doesn't stop market forces. Indonesia's President Suharto had ruled for 32 years. His regime was built on stability and growth. Now, both were crumbling. The rupiah, pegged at 2,400 to the dollar, started sliding. 2,600, 2,800, 3,000. Suharto's central bank governor tried everything Thailand tried. It failed just as quickly. By August 1997, 3 currencies had collapsed, but the worst was still coming. South Korea was different. This wasn't some small Southeast Asian economy. South Korea was the world's 11th largest economy. Home to Samsung, Hyundai, LG, a developed nation. Success story. Korean banks and corporations had borrowed over $100 billion in foreign debt. Much of it is short-term, much of it from Japanese banks. When Japanese banks saw what happened in Thailand and Indonesia, they panicked. They stopped lending to Korea. Worse, they demanded their money back. The Korean won, stable for years, started wobbling. Korean officials insisted everything was fine. The economy was strong, the banking system was sound, foreign reserves were adequate, but confidence once lost is almost impossible to recover. October 1997, the crisis spread to Hong Kong. The stock market crashed 23% in 4 days. Global investors began pulling money from all emerging markets. Brazil, Russia, Argentina. Fear became contagion. By November, South Korea faced the unthinkable. The won plummeted. 900 to the dollar became 1,000, then 1,200, then 1,500. Korean companies couldn't pay their dollar debts. Banks ran out of foreign currency. The entire financial system teetered on the edge of collapse. The Korean government had one option left. It's an option no proud nation wants to take. They picked up the phone and called Washington. The International Monetary Fund had rescued countries before. Mexico in 1994, various African nations. But never an economy as large as South Korea's. Michel Camdesis was the IMF's managing director. A French economist. Calculating. Methodical. He understood that if South Korea fell, the global financial system could follow. The negotiations began in late November 1997. Korea needed money fast. $57 billion. The largest IMF bailout in history. But the IMF doesn't give money without conditions. Camdesis arrived in Seoul with a team of economists. They presented their terms. Korea must restructure its banks, close insolvent institutions, open markets to foreign competition, raise interest rates to stabilize the currency, cut government spending. Korean government had no choice. On December 3, 1997, they signed the agreement. President Kim Young-sum appeared on television. His voice shook. This is a national humiliation, he admitted. Oh. But we must accept reality. The IMF money arrived. The won stabilized temporarily. The damage was done. Korean companies began defaulting. Daewoo Motors, one of Korea's largest firms, collapsed. Kia Motors went bankrupt. Unemployment soared from 2% to 8% in months. Families that built middle-class lives over decades lost everything. Men in suits lined up outside government offices, desperate for any work. Women sold gold jewelry to feed their children. The IMF bailout saved the financial system but devastated the people. Meanwhile, Indonesia descended into chaos. By January 1998, the rupiah had collapsed from 2,400 to over 15,000 per dollar. An 80% loss of value. Life savings evaporated. Prices for rice, cooking oil, and fuel skyrocketed. President Suharto, aging and increasingly disconnected, signed his own IMF agreement. $50 billion in exchange for painful reforms. But unlike Korea, Indonesia couldn't stabilize. The IMF demanded Suharto close 16 banks. These weren't just any banks. Many were owned by Suharto's family and political allies. When the closures were announced, panic spread. Indonesians rushed to withdraw their money from every bank, not just the closed ones. Lines wrapped around buildings, ATMs ran dry, the banking system froze. By February 1998, inflation hit 77%. Food riots erupted across Jakarta. Students protested in the streets. Suharto's 32-year grip on power began slipping. The violence escalated. Ethnic tensions exploded. Chinese and Indonesian businesses were targeted, shops burned, people died. Indonesia, once stable and growing, looked like a nation at war with itself. On May 21, 1998, Suharto resigned. The strongman who built modern Indonesia was gone. The rupiah crisis had triggered a political revolution. Thailand, where the crisis began, struggled differently. The baht stabilized around 42 the dollar, still far below its original peg but no longer in free fall. The Thai government implemented IMF reforms. Banks closed, companies restructured, unemployment climbed. The economy shrank by over 10% in 1998. Bangkok's construction boom reversed. Half-finished buildings dotted the skyline like tombstones. They called them ghost towers, monuments to misplaced confidence. Former Finance Minister Virabangsa Ramangkura later reflected, "We thought we were invincible. We learned we were fragile." Malaysia took a different path. Prime Minister Mahathir refused the IMF. He believed their medicine would kill the patient. Instead, on September 1, 1998, Malaysia imposed capital controls. Foreign investors couldn't pull money out for 1 year. The ringgit was pegged again, this time at 3.802 the dollar. International economists said it would fail. Failed investors called it madness. But Malaysia's economy stabilized. Growth returned faster than IMF countries. Mahathir proved there was another way, though it meant isolation from global markets. Back in South Korea, something unexpected happened. The crisis sparked national unity. A gold collection campaign began in January 1998. Ordinary Koreans donated gold rings, necklaces, and medals to help repay the IMF debt. Housewives, students, veterans. Over 3.5 million people participated. They collected 227 tons of gold, worth over $2 billion. It was more symbolic than economically significant, but it showed Korean determination to recover. Companies restructured aggressively. The weak disappeared. The strong got stronger. Samsung, LG, Hyundai. They emerged leaner and more competitive. By 1999, South Korea repaid the IMF loans. 3 years early, the humiliation transformed into pride. Throughout 1998, the crisis rippled globally. Russia defaulted on its debt in August. Long-term capital management, a massive American hedge fund, nearly collapsed in September. The Federal Reserve had to organize a bailout. Brazil burned through $30 billion defending its currency. They eventually devalued too. The Asian financial crisis became a global financial crisis. By late 1998, the worst seemed over. Currencies stabilized. Growth slowly returned. But the scars ran deep. Indonesia lost 13% of its economy in 1 year. Thailand lost 10%. Malaysia, South Korea, similar numbers. Millions fell back into poverty. Decades of progress reversed in months. The IMF declared victory. "We saved the global financial system," they said. Painful but necessary. But in Asia, a different narrative emerged. The IMF hadn't saved them. It had imposed Western rules on Eastern economies. It had forced fire sales where foreign investors bought Asian assets for pennies. Trust in the international financial system shattered. Asian nations vowed never to be so vulnerable again. They began preparing for the future. By 2000, Asia was rebuilding. To nothing would be the same. The final reckoning of the crisis revealed staggering numbers. Over $600 billion in market value was destroyed. 4 million jobs lost across the region. Suicide rates spiked in South Korea. Child malnutrition increased in Indonesia. But the balance sheets only told part of the story. South Korea emerged, transformed. The crisis forced painful corporate reforms. The old system of family-controlled conglomerates called chaebols had to modernize. Banks became more professional. Transparency improved. Samsung restructured completely. They sold non-core businesses, focused on electronics and semiconductors. The company that barely survived 1997 became a global powerhouse by 2010. Hyundai split into separate companies, focused on quality instead of just growth. Korean cars, once considered cheap imports, competed with Japanese and German brands. The crisis, devastating as it was, forced Korean businesses to compete globally. They came out stronger. Thailand took longer to recover. Ghost towers remained empty for years. But the financial sector reformed. Thai banks learned to manage risk. Central bank became more independent and professional. Tourism boomed. Thailand marketed itself aggressively. By the mid-2000s, Bangkok was a global destination again. Economy grew, though never as recklessly as before 1997. Indonesia faced the deepest transformation. Suharto's fall ended decades of authoritarian rule. Democracy came in messy, chaotic waves. The economy took years to stabilize. But by 2004, Indonesia began growing again. A new generation of leaders emerged. Rupiah never returned to its old value, settling around 9,000 to 14,000 per dollar. But the economy adapted. Malaysia vindicated Mahathir's controversial decision. Capital controls were lifted by 1999. Growth returned quickly. Foreign investors came back, though more cautiously. Malaysia proved the IMF way wasn't the only way. The broader lesson reshaped global finance. Asian nations collectively decided they would never depend on Western institutions again. They would never be caught with insufficient reserves. They began accumulating foreign currency reserves on a massive scale. China led the way, building reserves that exceeded $3 trillion by 2014. South Korea built over $300 billion. Thailand, Malaysia, even the Philippines stockpiled dollars. These weren't idle savings. They were weapons, insurance against future currency attacks, a declaration of financial independence. In 2000, Asian nations created the Chiang Mai Initiative, a regional currency swap agreement. If one country faced a crisis, others would lend foreign currency. No IMF required. No Western conditions. The power dynamic shifted. Asia learned to protect itself. Crisis also changed how international investors viewed emerging markets. The assumption that pegged currencies were safe evaporated, that high growth always disappeared. Risk assessment became more sophisticated. Hedge funds that profited from the crisis, like George Soros' quantum fund, became infamous. Soros himself later expressed regret about the social damage. "We were playing a game," he admitted in an interview. "They didn't fully understand the human cost." The IMF faced severe criticism. Its harsh austerity measures worsened recessions. Its one-size-fits-all approach ignored local conditions. By the early 2000s, the IMF reformed its policies, though the damage to its reputation in Asia remained. Joseph Stiglitz, a Nobel Prize-winning economist and former World Bank chief, wrote extensively about the IMF's failures. "They turned a financial crisis into a humanitarian catastrophe," he argued. The crisis revealed a fundamental truth about global finance. When the West controlled the money supply, the West controlled the rules. Asia determined that it had to change. By 2008, when the global financial crisis hit, the tables had turned. This time, the crisis started in America, not Asia. Asian banks, having learned from 1997, were more conservative, and their reserves protected them. China, flush with dollars, became a lender to America. The student had become the teacher. The legacy of 1997 shaped modern economic policy across Asia. Conservative banking, regional cooperation, skepticism toward Western financial advice. Indonesia, Thailand, South Korea, Malaysia, they all carry scars. But they also carry lessons. Currencies can collapse overnight. Growth can reverse in weeks. Confidence is fragile. Preparation is everything. The Asian financial crisis taught the world that globalization connects us all. A decision in Bangkok affects Seoul. Seoul affects Tokyo. Tokyo affects New York. The dominoes fall in every direction. It showed that even successful economies can fail if they're built on debt and overconfidence. That foreign capital is a double-edged sword. Those promises aren't guarantees. Most importantly, it proved that economic power determines political power. The nations that control the money write the rules. Asia understood this, and they started accumulating both. Today, when you see China's Belt and Road Initiative, or South Korea's technology dominance, or Singapore's financial power, remember July 1997. Remember the baht's collapse, the rupiah's freefall, the one's humiliation. They remember. They prepared. They transformed the crisis into resolve. The story of 1997 isn't just about currencies that collapsed. It's about nations that were rebuilt, systems that adapted, and a region that refused to be vulnerable again. Money, power, and memory. In the end, they're all connected. If you want to understand how the global economy works today, you have to understand what happened 27 years ago in Asia, when currencies collapsed, governments fell, and the world learned that nothing is too big to fail. Subscribe for more deep financial history documentaries.